So once again, thank you all for joining us for today's webinar, Not Your Parents' Retirement, Financing the New Retirement and Prop 19 Update. My name is Amy Miller, and I'm representing Twin Oaks, your host for today's presentation. For those of you who don't know, Twin Oaks is a brand new gated community in Hollister, California for adults 55 and over, and we believe that today's retirees are less interested in a sedentary retirement and looking for a more active lifestyle in their next chapter of life. When we started designing Twin Oaks, we did a bunch of research. Let me start sharing my screen so you can see our presentation today. Oops. There we go. Okay, can the panelists see that? Yeah, okay. Okay. So we did some research when we started looking into Twin Oaks, and we found that there are a couple of key priorities. One is security, and so we built Twin Oaks as a gated community. Another was access to services. And so our location just happens to be right next to the hospital and 90% of medical services in Hollister and across the street from shopping and dining. But most importantly, we found that people wanted a lifestyle. And so for Twin Oaks, the components of our lifestyle are health and wellness, lifelong learning, and social connection. Now, the heart of our lifestyle offering is going to be our clubhouse. And in this clubhouse, we're going to have fitness center, movement studio, a demonstration kitchen. We're going to have a pool and pickleball courts and bocce ball courts. And we hope to break ground on this community next month. We're waiting for our final permits from the city. So we're very excited that we're getting so close. We have already hired a lifestyle director who is actively engaged in creating programming for our current residents. This is her February calendar, and she's creating some great programs. And this presentation today is an example of one of our educational lectures that would be provided in the normal course for our residents. So with that, I'd like to introduce our expert panel of speakers today. First, we have Alexis Winder. She's a financial advisor and accredited asset management specialist. She has been a member of the Edward Jones Hollister branch for the last 4 years. Ms. Winder works with individuals, families, and small and mid-sized businesses to help implement personalized money management strategies that address current needs while working to achieve long-term goals. Tamara Powell is a JD and MBA and founding partner of Strategy Law Firm. She advises business owners and real estate investors on business transactions, including contract negotiation, liability protection, and entity planning. Ms. Powell has extensive experience with formation and representation of corporations, LLCs, LLPs, general partnerships, and limited partnerships. She handles 1031 exchange tax planning and other commercial real estate matters, including purchase and sale agreements, due diligence reviews and leases. And Ms. Powell also has an extensive background in tax law. Shannon Wilkinson is a California licensed CPA and QuickBooks Advanced Certified Pro Advisor. She has 20 years experience working with various Bay Area tax and accounting firms and has her own tax and bookkeeping practice that she started in 2018. She serves clients in Morgan Hill, Gilroy, and Hollister, and helps her clients with bookkeeping, tax planning, and tax returns. Now, one more matter of housekeeping before we get started. We want to make sure that everyone understands that this is an offering of general information in this presentation and not individualized tax and legal advice. So the information presented in this webinar should not be construed as the rendering of legal advice or accounting advice, and you should consult an expert and your professional advisor. Participants should not act upon the information presented without individual consultation with professional advisors, and any tax advice contained in this communication is intended for your use only, based on the accuracy and completeness of the facts you've provided, and may not be relied upon to avoid penalties. So with that, I would like to turn it over to Alexis to tell us more about living the new retirement.
Good afternoon. Can you hear me okay?
Yeah.
Perfect. Thank you. Thank you so much for having me. So I will briefly cover living the new retirement. And so when we think about retirement, it is a really exciting new phase of life. It's really what we've spent our entire adult life preparing for. And at Edward Jones, we believe that nowadays retirement looks differently, right? When I think about what retirement looked like for my parents or my grandparents, I think for most of us, retirement is going to look different for us today. So what do you need to know about this new retirement? How can you prepare for the new retirement? And what does it mean to retire today? Last year in 2020, Edward Jones conducted an extensive survey or study about the 4 pillars of the new retirement and identified 4 interrelated key ingredients along with the connected statistics for living well in this new retirement. As you can see on this slide, there are the 4 pillars are health, family, purpose, and finances. So taking one at a time. When we look at health, we all know that physical health may decline with age. However, emotional intelligence, or the ability to use emotions in a positive way, actually improves, according to a well-known study from the University of California, among others. However, not surprisingly, retirees do fear Alzheimer's and other types of dementia more than any physical ailment, including cancer or infectious diseases, according to our study. Moving on, we have family. Retirees get their greatest emotional nourishment from family relationships. This probably doesn't come as a big surprise. Most retirees will do anything it takes to help support those family members, even if it means sacrificing their own financial security. Conversely, retirees lacking close connections with family and friends are at risk for all the negative consequences resulting from physical and social isolation. I think that's something we've seen a lot, unfortunately, during this past year. Moving on, we have purpose. Nearly 90% of Americans feel there should be more ways for retirees to use their talents and knowledge for the benefit of their communities and society at large. Retirees want to spend their time in useful, rewarding ways, and they're well capable of doing so, given their decades of life experience. Retirees with a strong sense of purpose have happier, healthier lives and report higher quality of lives overall. And finally, of course, we have finances. Retirees are less interested in accumulating more wealth than they are in having sufficient resources to achieve the freedom to live their lives as they choose. Yet, retirees frequently find that managing money in retirement can be even more challenging than saving for it. And the unknowns can be scary. Almost 70% of those who plan to retire in the next 10 years say they have no idea what their healthcare and long-term costs will be in retirement. So that is a very high-level overview of the 4 pillars. Whether you are living in retirement or a new retiree, how can you best integrate these 4 pillars, health, family, purpose, and finances, into a fulfilling and meaningful way of life? The 4 pillars, as you can see, are highly intertwined and must be viewed and addressed holistically. They also change in retirement. So retirees need to be continually recalibrating and adjusting their plans. How these essential ingredients take shape and come together is different for everybody. Each and every one of you is going to have your own path to follow. And all people, especially pre-retirees, need to understand that the quality of their lives in retirement is rooted in what you do to improve your health, relationships with family and friends, sense of purpose, and finances as early as possible. If you're interested in more information about the 4 pillars, you can find the full report on our website, which is www.edwardjones.com. And it is a pretty lengthy report. This is just a very high-level overview. But I do want to give you something that you can take away today. And that is 6 steps that you should consider taking today to start considering the 4 pillars of retirement and how you can incorporate those pillars into your life. So they're all 6 steps are questions, okay? So let's start with question number 1, vision. What do you want to be able to do with your time and money? Outline a vision of what your ideal lifestyle in retirement looks like. Maybe make a list. Number 2, plan for the expected. Are you building the resources necessary to enjoy the lifestyle you've envisioned? We all know that we have goals for our retirement. What are those goals? What is passionate to you? What is something that you want to check off on your bucket list? Plan for that. Plan for the expected. Number 3, plan for the unexpected. This is a little bit more challenging, but are you prepared for the increasing costs of healthcare as you age? Have you taken the steps to maintain your financial independence and avoid burdening your family in case you need long-term care in the future? Number 4, start with a solid foundation. Do you have a solid investment strategy based on the principles of quality and diversification with a long-term focus? Number 5, leave a legacy. Have you created the estate plans necessary to leave the type of legacy you desire? And finally, number 6, keep retirement from being taxing. Do you have a retirement income strategy? Have you worked with your financial advisor and tax professional on a personalized strategy that takes into account your life stage and tax options? By addressing these and other issues, possibly with the help of your financial professional, you can set yourself on the path toward the type of retirement that's not really a retirement at all, but rather a new invigorating chapter in your life. Thank you very much.
Muted. Thank you so much, Alexis. I'm now going to turn it over to Tamara, who has some great information to share with you about the new Proposition 19, as well as some guidance that the Board of Equalization has released most recently. But one more disclaimer, we just want to make sure you understand that Prop 19 is a constitutional amendment, and so additional legislation, regulations, and statewide guidance are expected to clarify its implementation. Tamara?
Thank you, Amy. And that's absolutely right. Prop 19 is brand new. It was voted on in November. It came into its law in December. It's not even implemented yet. So there's still going to be a lot of information that comes down the line. What I'm going to talk to you about today is what we know. Prop 19 actually added 3 sections to our California Constitution in Article 13A. Section 2.1 talks about the intent of the legislature really being to provide property tax fairness, as they called it, for seniors, severely disabled people, and victims of wildfire and other natural disasters. Section 2.2 added 2 things: a California Fire Response Fund, which helps the state build up funds for fire disasters, and a California Revenue Protection Fund, which raises money for counties that may need it. Section 2.3 talks about when those counties can be entitled to funds from that California Revenue Protection Fund. Essentially, if you have what they called a negative gain or losses over the last 3 years as a result of people in your county paying lower property taxes because of Prop 19, you can be entitled to get some of that money back from the state. So how will these new benefits be paid for? They had to take away 2 benefits that we had in California prior to Prop 19 in order to fund it. The first thing they took away was limits on primary residence generational transfers, which I'll talk about in a moment. And the second thing they took away was the elimination of parent-child non-residence transfers. So transferring property that is not your home. So to start, we'll talk about your home. For your primary residence, under the old law, parents could transfer their home to their children, or if the parents were dead, then the grandparents could transfer to the grandchildren. And they could transfer that home to the next generation, either by gift, sale, or inheritance, and the next generation would not get an increase in their property taxes. There was no value limit. This transfer changes as of February 15th. That's the end of the old law. Effective February 16th, the new law, Prop 19, still allows for parent-child transfers. However, they're limited. Number one, the child must actually be living in the home. So you can't just transfer it to the child and let them rent out mom's home. Now you can only transfer it if the kids are planning to make it their personal residence and keep it that way. And there's still guidance to come about how long you have to keep it and what happens if you don't or if you move. But on top of that, you don't get to keep all of your property tax basis the same way it used to be. If the home has appreciated by more than $1 million, essentially you only get to exclude $1 million from the property tax basis going forward for the kids that now live in the house. So that in itself is going to create more property taxes for kids living in their parents' home. For example, if we had a home that had an assessed value at $300,000 because mom and dad bought it decades ago, and they're paying about $3,300 maybe in taxes each year because property taxes are assessed at about 1.1%. And now the home is worth $3 million. The kids will be paying property taxes based on a $2 million value rather than the $300,000 mom and dad had. So property taxes will definitely go up, which will help fund this new law. In the next slide, we talk about rental properties. So the old law was you could transfer your personal residence and up to $1 million of assessed value, that's your property tax basis value, of other property. There is no more $1 million exclusion for other property. So if you have a rental property, or if you have a home, your second home, for instance, or just your first home, and it's going to the kids and they won't live in it, that home will now be completely reassessed when it goes to the next generation. So any non-residence or any residence where the child doesn't move in will be reassessed on gift, sale, or inheritance. So that's how they paid for these new benefits. What are the benefits? Well, for your primary residence, there is now something we call portability of property tax basis. That is different than the old portability under Prop 60 and 90, which was the old law. So this gives you an opportunity to retire to a different home, move closer to your kids, just move for other opportunities, as long as you are over the age of 55 or severely disabled, or if your home was destroyed by a wildfire or a disaster, you can now transfer your property tax basis to a new house of any value anywhere in the state. So the old law, you had to transfer to a home that was equal to or lesser in value to your current home. The new law doesn't provide restrictions on that, but it just does provide some increases, which we'll talk about, to adjust if you go into a house that's worth significantly more than your current house. Okay, so the benefits of this. Obviously, you get to keep your property taxes low. In California, property taxes are a major expense during retirement. If you have as we mentioned before, a $3 million house, you could be paying $33,000 a year in property taxes, and those are after-tax dollars you need to pay that. So it's very pricey. Under Prop 19, you get to keep your lower property tax bill from your old house, move to a new house anywhere in the state. You can move to a more expensive home. Your property tax bill will go up a little bit, but certainly not by as much as it would be if you were buying it without this transfer. So for example, if your old home sold for $2 million and your new home was purchased for $2.2 million, you would get to keep that old property tax basis and just add the extra $200,000 in value to it. So if you had purchased your old home and it was only assessed at about $300,000, it would go up in this case to $500,000 of assessed value instead of the $2.2 million purchase price that you bought the home for. Huge advantage. Also, you get to transfer to any county in California. The old rule was limited, and I'll show you some of that in the disaster rules in a second. Now, it doesn't matter which county you're in, as long as you're in California, you can go ahead and do the transfer. The old rule said you can only transfer once. Now, you can use this Prop 19 3 times in your lifetime, or even more if you're an unfortunate victim of a governor-declared disaster. Then you can go ahead, and if your home burns down, you can transfer that property tax value to a new home. And when I say new home, you can also transfer to a home that you construct, which is very helpful for fire victims if their home burns down and they need to build a new home to match what they used to have. So we should address that a big part of why this passed was the support of the fire services and the tragedies that we experienced this year in California. So it's important to talk about what this means if you were to lose your home in a disaster. So the next 2 slides that I'm going to show you talk about disaster relief and how you transfer your base year value in an disaster. So first, intra-county. If you're transferring in the same county, under the old rule, it had to be in the same or a limited number of counties, and you could transfer to a house that was worth up to 120% of the value. Now, any amount over 100% of the value would be added to your property tax basis. But one of the advantages of the new rule is it's not limited anymore to a disaster, which the governor has to proclaim as a state of emergency. Now, any wildfire counts, or any natural disaster such as an earthquake as declared by the governor. So remember, this new law, Prop 19, is effective as of April 1. The Prop 58 benefits for parent-child transfers we talked about went away as of February 15, but this new law is effective April 1 for the transfers. So the next slide talks about inter-county disaster relief. Under the old law, you could only transfer within 13 counties that had approved these types of inter-county transfers. Now you can transfer anywhere in California. So that's a huge benefit. And that's something that otherwise had become an issue as far as how portable really your property tax basis was, because you were limited to where you could move it to. Okay, so regardless of the disaster rules, April 1 is the effective date for transferring your property tax basis. And it's important to think about what that means timing-wise, because there were a lot of questions that the general public was asking after this law came out, and the Board of Equalization has just started to answer some of these questions for us. So timing. To receive these portability benefits of the new Prop 19 law, homeowners have to complete only one of the transactions on or after the effective date of April 1st. And you have 2 years from the transfer of the first property to complete the second transaction. So you could sell your property before and purchase another property within 2 years. As long as that second transaction is after April 1st, you do fall under this new law. So here's a couple of Q&As that came straight from Board of Equalization's recent frequently asked questions. you sold your home before April 1, if you buy your new home or complete the construction on your new home after April 1, can you still transfer your prior home's low assessed value to the new home? The answer is yes, as long as you are on or over age 55 or severely disabled or the victim of a wildfire or disaster that's declared by the governor, and the second transaction occurs within 2 years from the date of the first transfer, you do qualify under the Portability Act, Prop 19. So what does that mean dollar-wise? On the next question, it talks about if you sold your home with an assessed value of $300,000, this is the example I used earlier, that's your property tax basis value, not fair market value. So property tax basis was $300,000, you sold for $2 million, plan to buy your new home for $2.2 million. Under the old law, you used to be able to carry over your basis as long as the purchase price was within 110%. Does the same apply in Prop 19? No, the extra $200,000 in value will be added to your property tax basis. And so you will pay the $300,000 plus the $200,000, or you'll be paying property taxes now based on $500,000 instead of $300,000. So there will be a lot more questions that people will have for their individual circumstances. And I encourage you to go to the Board of Equalization's website, as well as the county website for the county you're in. Board of Equalization is working very hard right now to try to normalize things amongst counties. But BOE is the first place you go for questions on how Prop 19 will be enforced. And this information, both the website, an email, and a phone number is available for you. Thank you.
Thank you very much, Tamara. I would now like to introduce Shannon, who's going to talk about some other tax considerations in retirement.
Hi, thanks for having me. I'm Shannon Wilkinson, and I am here to talk about income taxes. Tamara talked about property taxes, and considerations in retirement. So how do we create a retirement plan? Each person's situation is unique. So creating a vision of what your retirement is going to look like is such a personal process. And it can be especially challenging because you have to think about things like your own mortality and planning for future healthcare costs. So it's important to be realistic, and we have to think about what our income and our expenses are going to be during retirement. How is your spending habits going to change once every day is like Saturday, right? So you're going to be spending more on probably travel and entertainment once you're free from your day job. So, and housing expenses can make up a large part of that budget. So is part of your retirement plan to relocate and downsize? So retiring means more time and freedom for things like travel, shopping, and eating out. What sources of income will be financing those extra expenses? Some types of income will be taxable, and some of your expenses will be deductible. It's important to know what the take-home or your after-tax income is going to be. And then once you have a plan for how much money is going to be coming in and how much money is going to be going out and what your taxes will be, you'll have a better answer to the question, do I have enough saved for my retirement? So these will be the main topics for tax considerations: relocation, income during retirement, and tax deductions. So on talking about relocation, one of the options retirees need to consider is whether they want to sell their home and relocate. What are the financial consequences of selling your home? Consider the costs that will be involved, such as commissions and other fees on the sale. And there could also be tax costs. Okay, so now it might be a good time to take notes. So I'm going to put on my teaching hat and introduce a few vocabulary words. There are a few special terms we use when talking about tax on a property sale. What is gain? The gain from the sale is a formula, and it's basically calculated as your selling price minus your basis minus your selling costs is your gain. So what does that term basis mean? That's part of the formula. Another word for basis is cost. What was originally paid for the property plus what improvements were made to that property over the years. So you subtract your basis along with the commissions and other selling costs, and that's your gain. Think of the gain as the profit on your sale. As an example, say a home sells for $1 million and the selling costs and basis add up to $300,000. That equals a gain of $700,000. In most cases, the IRS wants taxpayers to pay taxes on their profits. So the next consideration is whether that gain is taxable. The answer is maybe not all of it. Married taxpayers are allowed to exclude up to $500,000 of gain from their taxable income when they sell their home, but only if they meet certain criteria. Single taxpayers are allowed half, or $250,000 of exclusion. The basic criteria to qualify for that exclusion is that you have to have lived in the home for 2 of the last 5 years. In my $700,000 gain example, that means a married couple may only need to pay tax on $200,000 of that gain. So once we're able to calculate the tax costs, we can calculate the cash flow that can be rolled into the purchase of a new home. Assuming the mortgage is paid off, then you take your $1 million, subtract the commissions and the income taxes that you have to pay, and the rest goes into the bank. And then it's time to go shopping for a new home. Remember to consider how the housing costs will change when moving into a new home. Tamara already discussed the potential changes in your property tax expense. Other expenses you might want to consider are utilities, insurance, HOA dues, and whether there will be a monthly mortgage payment. Be sure to include those expenses in your retirement planning. Okay, the next slide. We're going to talk about income during retirement. Some common sources of retirement income are pensions, 401k plans, Social Security, and both retirement and non-retirement investments that you saved. It's important to know which categories are included in your retirement savings because some of these items are taxable and some are not. The after-tax amount is what needs to be included in your retirement plan. I've listed a few common types of income, so let's ask that question, is it taxable for a few of these items? Let's start with Social Security. Is it taxable? The answer is it depends. Up to 85% of your Social Security income could be taxable, depending on how much income you have from other sources. If certain thresholds are met, it triggers the tax, but you will never be taxed more than 85% of your Social Security. So for $100,000 of Social Security income, the most that would be included on your tax return as taxable income is $85,000. Non-retirement savings includes things like your checking account, your savings accounts, and your brokerage account that holds stocks and bonds outside of your retirement. The interest, dividends, and taxable gains earned on these accounts are generally taxable except for some types of government bonds. So please consult your tax advisor about your personal portfolio. Traditional IRAs and Roth IRAs, people get confused, so I listed those here so we could talk about them. So a traditional IRA is a type of retirement savings account. Owners contribute to these accounts over the years and do not pay tax on the contributions. They also don't pay taxes on any of the earnings until they start taking distributions in retirement. Withdrawals from IRA accounts, also known as distributions, are usually 100% taxable. And now we're going to talk about something called RMD. RMD stands for Required Minimum Distributions. It's basically a minimum amount that you are required to take out of your IRA account once you reach a certain age. They don't let you keep it in there forever to grow tax-free. Okay. It's based on the value of your accounts and a life expectancy table. The age requirement for RMDs used to be the year you turn 70 and a half. Now it's age 72. Remember though, that the CARES Act, due to COVID, gave everyone a pass on taking their RMDs in tax year 2020. So everybody's getting ready to file their 2020 tax returns. Just know that there was a pass just for that year. Okay, now Roth IRAs, how are those different? Roth IRA contributions were made with after-tax dollars. So that means taxes were paid on the contributions. And the big difference between IRAs and Roth IRAs is that the Roth IRAs grow tax-free. So when you start taking distributions in retirement, you do not have to pay tax on any of those distributions. It doesn't even go on your tax return. 401k plans, pensions, STIRs, and PERS are other common types of retirement income that have tax considerations. Inheritances can sometimes have tax consequences. And sometimes you're only semi-retired and your employer hires you back as a consultant. So then you might have self-employment tax considerations. So please consult your professional advisors to help you evaluate your retirement income and which items will be taxable and which items will be non-taxable. Okay, the next slide is about tax deductions. So we already discussed expenses for housing costs, travel, entertainment, but don't forget to include everyday expenses in your plan, like health insurance, medical expenses, groceries, vehicle costs, and charity. Some of these expenses may be tax deductible. So let's talk about deductions that go on the tax return. Some of the main categories are state and local tax, also known as SALT, mortgage interest, and charitable contributions. Medical expenses may also be deductible, but only if they meet certain thresholds. SALT taxes, that's the state and local tax, also have a limitation. For tax year 2018 through 2025, the feds put a cap on the SALT deduction of $10,000. And remember, the SALT category, it's not just your property taxes, but it's also your state income taxes. So that's a severe limitation on your deductions. Since we talked earlier about relocating, then it's important to know about the tax law that affected the mortgage interest deduction starting December 15th, 2017. Taxpayers who purchase a home after that date can only take an interest deduction on up to $750,000 of debt. Taxpayers with loans before that date still fall under the old maximum debt limit of $1 million. Charitable contributions are more of a discretionary expense, which means you have control over those, and we use those as a tax planning tool a lot of times to increase your deductions. New in 2020 is an above-the-line charity deduction up to $300 that can use whether you itemize your deductions or not. Now, what do I mean by itemizing? Instead of having to add up all of your deductible expenses, the IRS allows a straight, flat standard deduction. Taxpayers are entitled to take the higher number, whether it's the standard or the itemized amount. So the next slide we have the table. This is from a handout that Alexis provided from Edward Jones, and I believe it can be provided as a handout if you reach out to Amy. So if you're not sure about your standard deduction amount, you can consult a chart like this, and it shows the standard tax tables. I'm sorry, it shows the income tax tables as well as the standard deduction amounts. So as an example, a married couple receives a standard deduction of $24,800. Then they get to add another $1,300 each if they're over age 65. The tax tables can give you an idea of which tax bracket you fall under. If you take your income minus your standard deduction, that's your taxable income. The taxes are calculated on a tiered system. So you've got to calculate the lower tiers first and then use your bracket for the last portion of your income. That highest bracket is called your marginal rate. Use this marginal rate to calculate any financial decisions. If you receive, for example, if you receive an additional $100 of income and you're in a 24% bracket, the additional tax on that will be $24. Once you're able to calculate your taxes, that's the final expense that needs to go on your retirement plan. So now you should have a good reflection of your income and your expenses during retirement. Once you're able to create your own personalized retirement plan, it can take away some of those unknowns and those uneasy feelings about whether you have enough saved. No matter what your stage in life, having a solid plan can offer such peace of mind. It ensures you will always have enough for the things you need and helps you plan for the things you want. I hope that you learned some new tax terms and saving strategies today. Remember to live in your home for 2 years before you sell to avoid a capital gains tax. We discussed how to calculate gain if you sell your home and what does basis mean, what types of income are taxable and non-taxable, when to start taking your RMDs, what expenses are deductible and which ones are subject to limitations, using standard versus itemized deductions, and finally, how do I calculate my tax and plan ahead for my future? Thank you very much for having me today.
Thank you, Shannon. And a huge thank you to all of our panelists today for taking time out of their incredibly busy schedules. Tax season is coming up, and I know they're all working very hard these days. And thank you to all of our participants who joined us today. If you are interested in receiving a copy of the handout that Shannon showed or a copy of this presentation, you can email info@twinoakshollister.com and we will send it to you as soon as it is available. So thank you very much, and we appreciate you joining us.